From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning and welcome to another episode of the Macrocast. I'm your host, Bryan DeAngelis, partner here at Penta, and I'm joined, as always, by our colleague and friend, John Fagan from Markets Policy Partners. We gave Brendan the day off. I think he's out in Utah doing something fun.
He's hip deep in powder.
Yeah, good for him.
City.
Love it. But we have a very special guest joining us from the Penta team, Jill Craig, our partner in Penta's Brussels office. And we're here today. We'll cover some of the big news this week, John, with the Fed, but we also asked Jill to join us and give a little bit of the European perspective as today marks the 1 year anniversary of the Russia-Ukraine conflict. So we'll dive into all of that in this episode and probably a lot more. John, let's start with you, though. Hot off the presses, the Fed's, I don't know, formerly favorite inflation reading, maybe still favorite inflation reading, core PCE. What did we get this morning and how are folks reacting?
Yeah, another day, another upside surprise in U.S. economic data and more pointedly, U.S. inflation data. Core PCE, the core PCE price index, not exactly something that rolls off the tongue, right. But it was, as you say, the Fed's focused on this as their particular preferred metric for a long period of time. I think that's probably changed. That's evolved a little bit, but nevertheless, the core PCE index came in hotter than expected today, but markets were already bracing for this. We'd seen upside surprises for January's consumer price index and producer price index. All the other indications had shown that there was a reacceleration of the economy and prices in January. This has completely changed, the narrative in markets from a sort of placid January where we were, experiencing this anticipation of the end of the Fed's tightening cycle, and the data that's come in from January as we've gotten into February here has basically upended that expectation and put markets on notice that the Fed has more to do, and it's not taken it particularly well. This is the inflation, you couldn't call this good news, the inflation number being hotter than expected, but it's been accompanied by much firmer economic activity readings like this month's consumer spending and personal income data comes in, looks up, above 1%, a big rebound from December. Yeah. So this is, but these positive economic readings aren't being taken as good news. They're being taken into feeding more Fed aggression and over the coming meetings, a higher end of the tightening cycle and perhaps a harder landing in the second half of the year as a result.
Yeah, we talked about this a little bit last week. I mean, it feels like, you can choose your own narrative around this economy and depending on who you talk to, it's getting great. Here comes the soft landing. It's not great yet. Get ready. It's pretty clear. We also had the minutes from the Fed meeting released this week. It's pretty clear they're still very much kind of armed and in a fighting posture on inflation. There was several members, I want to say that they were pushing for even a higher interest rate hike last time around. I think this data certainly suggests we're going to continue to see their foot on the gas in terms of interest rate hikes. Where do you see this headed? Do you still see kind of an end of year easing up or too early to tell on that front?
Yeah, it is interesting looking at the way that the Fed has communicated. Essentially, it's not so much that their communications have changed over the past month, right. It's that the market's now listening.
Exactly. The Fed's not surprised. Yeah,
it really came down to the data coming in and validating what the Fed had been saying. And if you looked at just December and the slide into a very weak December number, then, the markets were not offside in thinking that the Fed would probably get maybe another couple of 25 basis point rate hikes and maybe get rates up to 5% and then put it on hold. Let, the lags in policy are well known and let those feed through the tightening that's already occurred. And then, reassess over the coming meetings. But that is not what the Fed had really been saying. There had been a big disconnect between markets pricing, the futures, Fed fund futures, et cetera. And so there's been a big readjustment. Now the terminal rate, the peak of the tightening cycle has been marked up from, a finger in the wind around 5% to about 5.5%. Right. So that's a big move. But when you cast your eye out on Fed fund futures, they're still pricing in those additional rate hikes that just got priced in being priced out by cuts that are anticipated in sort of the December to January, maybe even as soon as November timeframe. And that is consistent with stubborn expectations for a recession in the second half of 2023. And so, despite the strength of economic growth now, that is not giving markets a lot of comfort that the economy will escape a recession. There's been a lot of commentary from Wall Street economists that this is, it's not a hard landing, it's not a soft landing, it's no landing. The economy is going to reaccelerate here, but the markets aren't buying that. And they still, based on what the markets are seeing, they're still it's a grim second half of the year outlook based on market pricing.
So can we go deeper on that? Because, we've certainly spent a lot of time and oxygen over the last few weeks discussing that. It seems like I was starting to be a believer in the soft landing. We even talked about, to your point, no landing. Do you think is it this latest data, or what's kind of spooking markets that this recession that seems to have been on the horizon now for months, if not quarters, and just keeps getting further and further. We never quite get there to the end of the rainbow, if you will. But now it seems like they're a little spooked that not only will it be here, that it may actually be a pretty hard crash into it that leads to cuts. Is that kind of your read on things?
That's certainly, if you're looking at the classic market-based recession indicator, the yield curve, the 2s, 10s part of the yield curve, or whichever part of the yield curve you want to look at, the Treasury yield curve, it is deeply inverted. The 2s, 10s, which is kind of the main one that people look at, everybody has their own favorite, but 2s, 10s is as inverted as it's been since like 1981. It's it's blaring a recession signal every time. Markets are obviously equities had a horrible 2022. We got a little bit of a bounce in January. We've given a lot of that back in February. So equities don't like what they're seeing in particular. And, and when you look at commodities, it's not as though, oil prices and copper prices and so forth are really juiced up here. This is, we're at multi-month lows in oil prices, which is consistent with a pretty glum economic outcome. Even with China's reopening, there was a lot of expectation that would go up. So there's a sense that, if you look at December was really weak. If you look at January, it's really strong. Kind of put them together and what do you got? And you still have, it doesn't really change the narrative that the economy, unless you take January as a reacceleration rather than just a rebound from an exceptionally weak December. And so I think that, the concept that markets are conveying is that January's strength is kind of a head fake. And even if it's not a head fake, then, the Fed is going to land this plane, right? They're not going to let this plane
hit the ground.
Because prices would take off right with it. And the Fed wouldn't see that. So that just wouldn't countenance that. And so you have a situation in which, one way or the other, prepare for landing. We're going to have, the economy is either going to touch down in a gentle trend here that the Fed has engineered, or the Fed is going to have to, again, really apply the brakes and potentially put us into a hard landing to wring out the economic, animal spirits and price pressures.
On that point, and maybe to wrap up this segment, you can yell at me later, but I love putting people on the spot. You think the next rate hike, they go back up to 0.5, or are they just going to stay steady at a quarter?
I think that they're going to stay steady at a quarter. I mean, they've already done a lot of tightening. As I said before, I don't think that the Fed's really taking the bait that much when it comes to these data points that we're seeing in January. I think that, Fed Chair Powell said as recently as the early February meeting that the disinflationary process has begun. Is he going to walk that comment back? I don't think so. No. I think he's probably going to do what he did with the, non-farm payroll number, which is basically say, hey, that's 1 month, right? And there are a lot of idiosyncratic aspects, particularly around the end of the year dynamics in January and the weakness in December and weather and, warmest January and forever. And so the sense that I've got is the Fed is, they know that they're near the top. This is not the time to make any hasty maneuvers. They've got the March meeting, and then they've got, a sequence of June and July meetings, and they can, take their time. Inflation is it's ticked up a little bit here, but it's not like roaring back. And by a lot of different metrics. And so I think that they're going to stay on this measured 25 basis point pace and take it that step by step. And we'll see if they get to the market is expecting 5.5% by June. They're at 4.75 now. We'll see if they get there. There's a lot of time. Look at how the narrative changed in 2 weeks.
Right. I was going to say.
Right. So then we could be right back into, economic slowdown as the dominant narrative in another, flash forward another 2 weeks, and we could be there.
Yeah. But your point is right. I mean, forgive the bad dad joke, but he'll circle the runway as long as he has to before he lands this. I think he's had a pretty good vision the whole time and kind of ignoring the noise and really just kind of staying focused on what he wants to do. That's great. Well, let's take a break here. We're going to jump deeper in some of the global issues we've been discussing, particularly around Russia, Ukraine in our next segment with Jill Craig, and we'll be right back here on the Macrocast.
Corporate leaders find themselves operating in a complex environment with the need to manage multiple stakeholders. On What's at Stake, a Penta podcast, you'll hear from executives, communications professionals, and other experts on how companies can better define, inform, and strengthen their decision-making, as well as their understanding of their own stakeholders. Tune in each week at the Penta podcast channel and find us online at pentagroup.co.
We're back on the Macrocast. As I mentioned in our intro, we have a special guest with us today, Jill Craig, Penta partner who runs our Brussels office. I invited Jill to join us today to mark the 1 year anniversary of the Russian invasion of Ukraine. Jill, thank you for coming on the show. We appreciate it.
Thanks for having me back.
I'd love to maybe just start. This is a big week. We've seen a lot of media attention to mark the 1 year anniversary. U.S. President Biden went over to Ukraine at the start of the week. I'd love to just get a little bit of your thoughts and your perspective sitting in Brussels of what it looks like a year in, maybe what we've learned, and if that we is Europe versus the rest of us, that's fine. And where do you see things going from here?
Yeah, I mean, I hope we learn a lot of things from this conflict, but let me just pick out a few that come to mind. I mean, I think that the first and really important point is that conventional war is still possible between two developed countries, and we shouldn't let that slip our minds, and that it's still terrible when it happens. Yes. And we shouldn't underestimate, the devastating kind of human impact that this conflict will have for generations to come on the Ukrainians. I think another thing that we've learned is that Western unity can still be strong, and we spend a lot of time, arguing, especially transatlantic. But when it really comes down to the core things, we are united on some key topics. Even at EU level, sometimes the EU can really struggle to come up with a united foreign policy, but it's managed to do that so far on Ukraine, which has been, really a positive. I think that will be tested, frankly, the longer that the conflict goes on. But so far, it's really held up. And maybe lastly, just to pick out something which I think is of particular interest to us who spend our time, looking for solutions to stakeholder problems. I think one thing that's really come out of this conflict is the impact that private citizens and indeed companies have had. If you think of, the volunteer hackers, for example, who have been busy at the beginning of the conflict, and indeed if you think about also the big global companies who've pulled out of Russia and taken their investments with them, and these things have really had a significant impact on the financial state of this conflict.
Yeah, that's an excellent point. We've seen a tremendous response even from the business community, and to your point, their stakeholders as well, really holding them accountable. Not that many of them had to be kind of forced to do it, but really just a lot of attention on it from all angles.
Yeah, and indeed some backlash on those who were a bit slower to move.
Yeah, totally. I want to jump back on that second point. We really did see the West come together. I don't want to necessarily compare it to Cold War times, but really, early test since then, and watching a lot of folks not only lock arms, but I've been impressed by the continued commitment. We are now a year into this. I think a lot of folks thought this would last a few weeks, maybe a couple of months. Ukraine would fall quickly and the global community would have to respond in that sense. But here we are a year later where we're still kind of firmly behind it. We see, a lot of great support, both from the U.S. and Europe. And it looks like despite some grumbling here in the United States, I think there's no end in sight in terms of that commitment. I'm curious what you're seeing, maybe in the EU, is that there are some big leaders like France and Germany and others who seem very vocally committed. Are there any disruptions within the ranks beyond that?
I think it was, you mentioned Joe Biden was in Kiev this week. I think that was pretty well received, very positively received across Europe. Timing was, of course, perfect just before President Putin's State of the Nation address, and indeed just before there was a high-level Chinese visit into Moscow. So, I think it's important to realize that during the US midterms, last November, we from here in Europe were watching very closely to see what the likely commitment towards Ukraine would be like post-election, and whether or not we could rely on continued US support after those elections. And so I think it was, no surprise that the German government spokesperson called that visit this week a good signal. I think that was the expression that was used. And you're quite right. There is, that unity is still there. None of us really expected, I think, Ukraine to be quite as resilient as it has been in this conflict. And indeed, I think we need to remember as well that Ukraine has been at this not just for the 1 year that we're commemorating today, but for almost 10 years since Russia annexed Crimea. So they're in very much for the long haul. They're looking very bullish at the moment about the situation. But let's see how things evolve. I'm not a defense expert, but the snows are melting. Things are getting muddy. But before too long, the ground will be hard again, and then we'll be able to see what that impact that has on the warfare element of this conflict, which is pretty brutal. I think another thing that you talked about unity. I've mentioned that too. But I think one thing that we didn't really expect was the response of the global South, or what we're now calling the global South. We like to talk about, that unity in the West, even among democracies, but there are some significant democracies that form part of that global South group who have declared themselves neutral, which is looking a bit less neutral than it sounds. So, I think that the impact of that is still to be seen in the years ahead. even after this conflict is over, which hopefully will be soon.
Yeah, I think that's an important point, and maybe a topic for a future podcast too. Likewise with the positioning of China, we will see today China present its plan, quote unquote, for peace at the same time that the U.S. is coming out with some serious charges of China actually aiding and abetting Russia's efforts. And so we'll continue to see that struggle between those two superpowers and how that's playing out in the global south and other parts of the globe.
Yeah, I think that would be a great topic for a future discussion.
Yes.
Europe seeing itself very much in the middle of that battle between the US and China.
Absolutely. Let me dive into some of the economics, the supply chain. You know, the conflict initially had some pretty significant impacts on global supply chains, energy prices. Russia's obviously a huge source of energy for a lot of Europe and elsewhere. John knows this well. Fed officials here, cited the war as a big reason why, we saw inflation remain high for so long. Globally, we've seen those higher energy prices and food prices, but, maybe not as big of an impact as we quite thought. So I'm curious, Jill, how's the EU been handling these challenges? What have they kind of learned from those lessons as well?
Yeah, that's a great question. I mean, there's no question that Europe has been hugely over-reliant on Russian energy sources for too long, and it's clear that this conflict has pushed us into facing up to that, really. And I saw a stat just this week that said that Europe's reliance on Russian gas has gone from about 83% or something to 20% over the last year, which is really significant. And to achieve that sort of level of transition, there's been a huge investment in renewable energy infrastructure, which is in line with Europe's climate change goals, but also through significant supplies of US LPG. So, the diversification of all those supply chains is indeed, opening up the other markets. I mean, Russia and Ukraine is, of course, a huge source as well of agri-commodities and minerals. So losing access to those has also meant we need to diversify where those supplies were going to come from. And that's led to a range of things in Europe, not least, I suppose, the decision to reopen talks on a free trade agreement with the Mercosur countries of South America, which, for those trade watchers out there, you will know that FTA was agreed a long time ago in 2019, but has been in the freezer since then. And now it's not the only reason, but definitely the diversification of supply chains has forced the EU to look for other geographies that could be friendly towards supplying some of those key commodities that we need.
Yeah, that's we've seen the same here in the U.S. through COVID and this crisis of, maybe we should have revisited some of those.
Some of that. Yeah. But what's remarkable, I think, is that and encouraging to see is the huge support that EU citizens still have for Ukraine and for the financing and of supplies to Ukraine, despite the fact that, as you said, the energy prices have risen dramatically, food prices also, and the cost of living is really soaring. But the support overall for what Europe is doing is still very, very high.
I actually wanted to wrap up and end on a similar point there, Jill. We've seen, obviously a lot of fast and strong support, both from governments and citizens in support of Ukraine. We've seen heavy investment on the military side of things, but there will be a major reconstruction effort that's required once this conflict comes to an end. And I think I speak for all of us where we hope that is much sooner than later due to the human suffering and the toll it has taken. As we think about rebuilding, and John, feel free to jump in here too. I know you've got some expertise here. How prepared do you all feel that the EU and the US, and maybe how committed will they be to rebuilding Ukraine?
I think the commitment will be there. I think it was interesting to see at last weekend's Munich Security Conference that the European Commission's president, who is herself a former defense minister for Germany, make very clear that she thought it was what she called unthinkable that Russia would not pay for Ukraine's reconstruction. So that already gives an indication of where she thinks the cash is going to come from for that. But I would imagine that many governments around the world would be aligned with that sort of thinking. Yeah,
and as you know well, Bryan, obviously the U.S. commitment is solid right now, but is far from unanimity on that. And the 2024 election might have significant consequences and ramifications for the U.S. commitment to a reconstruction program in Ukraine.
Yeah, I unfortunately think you're right there. We are seeing a kind of loud and growing minority within part of our political system that's getting skeptical. Again, unfortunately, but hopefully the U.S. will stay committed here, as I certainly expect Biden and this administration to do that. We'll see hopefully what comes in 2024. With that, obviously a tough subject, and I think we all wish we weren't here marking a 1-year anniversary, but it is a testament to the resilience of Ukraine and the global support that they've received. Hopefully we all will see a swift and peaceful resolution soon, but let me leave it there. I'm sure we'll come back to this topic many times over the course of the next few months. Jill, I want to thank you for joining and for joining very last minute. I appreciate the call, taking the call from overseas and jumping in here. We appreciate it. And John, as always, a great conversation. To our listeners, thank you for tuning in to another episode. You can find all of our episodes wherever you get your podcasts, Spotify, Apple, and of course on our website. Follow us on Twitter at PentaGRP, and we will be back next week with another episode.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.